When a business makes any important decision, the key question is whether it creates value. Whether launching a new product, acquiring another company, investing in technology, or reviewing how the company is financed, the decision depends on comparing the expected returns with the cost of financing those returns. The weighted average cost of capital, or WACC, is the benchmark used for this comparison. It represents the average return a company must pay to all its sources of capital, like shareholders and lenders, based on their share of the company's overall funding. Essentially, WACC is the minimum return the business needs to earn on its investments to satisfy those who provide the money. If a project returns more than the WACC, it adds value; if less, it destroys value. Because WACC connects market conditions, risk, strategy, and valuation, it plays a central role in modern corporate finance. It shows how the blended cost of equity, debt, and sometimes preference shares or other instruments come together to finance the company's assets. Each type of capital has its own cost, and understanding these costs helps businesses make informed decisions that drive growth and value. This presentation will explore what WACC is, why it matters, how to calculate it, and its practical uses through examples. Equity holders expect returns that match the risk they take on, while debt holders require interest payments that account for the chance a company might default. Preference shares usually offer fixed or semi-fixed returns. The weighted average cost of capital, or WACC, combines these costs based on their market value proportions in the firm's total capital. The formula weighs the cost of equity and debt, factoring in the tax benefit from interest being deductible, which effectively reduces the debt cost. WACC isn't just theoretical, it directly influences business choices. For investment decisions, it's the benchmark to see if a project's return is worth pursuing. If a project's return exceeds WACC, it adds value; otherwise, it doesn't. When valuing a company, WACC helps discount future cash flows to find the enterprise value, with even small changes in WACC causing big shifts in valuation. In managing capital structure, companies use WACC to find the optimal mix of debt and equity that minimizes costs without adding too much risk. Finally, WACC is a key part of assessing performance through metrics like economic value added and comparing project returns to ensure they exceed WACC, confirming true economic value creation. Calculating WACC involves several key steps. First, determine the capital structure using market values because they reflect the current opportunity cost for investors. This means calculating equity as share price times the number of shares and debt as the market value of borrowings. Next, calculate the cost of equity using the capital asset pricing model, which considers the risk-free rate, the stock's beta or systematic risk, and the equity risk premium. This gives the return shareholders expect based on the firm's risk. Then, calculate the cost of debt, which is usually the yield to maturity on existing debt or the rate the firm would pay if it issued new debt today, adjusting for taxes since interest is tax deductible. After that, weight the cost of equity and after-tax cost of debt by their proportions in the company's total capital to get the overall WACC. For example, a manufacturing firm planning a £50 million expansion might have 60% equity at a 10% cost and 40% debt at a 5% cost with a 25% tax rate, leading to a WACC of 7.5%, meaning the project has to generate returns greater than this to add value. The advantage of using WACC is that it provides a realistic, blended measure of capital costs, reflecting all funding sources, and serves as a clear benchmark for decision-making since returns must exceed WACC to create shareholder value. Using a single cost of capital helps keep everything consistent across how we appraise investments, value the business, and measure performance. The weighted average cost of capital, or WACC, is widely accepted around the world and used by corporate finance teams, investors, regulators, and analysts, which makes it easier to explain and justify decisions. However, WACC isn't perfect. Its key inputs like beta, market risk premium, and target capital structure are based on estimates, so small changes can have a big impact. It also assumes a constant mix of debt and equity, which might not be true if a project changes leverage significantly. Additionally, using the same WACC for all projects can lead to mistakes, especially if projects have different risk levels. Riskier ones need a higher discount rate, safer ones a lower rate. Market conditions can also cause WACC to fluctuate regardless of how well the company is performing operationally. When used properly, WACC helps ensure that growth is disciplined, preventing companies from expanding just for the sake of it and making sure capital is put to work where it can earn returns that justify the risk. More advanced companies often adjust WACC by business unit or geography, apply project-specific hurdle rates, and combine WACC with scenario analysis and sensitivity testing, turning it into part of a broader capital allocation strategy rather than just a single number. The weighted average cost of capital is a key idea in corporate finance that connects risk, the capital markets, and the choices businesses make. It helps answer a straightforward but important question: what return does a business need to earn to justify the capital it uses? By setting a clear standard for judging investments, valuing companies, and measuring performance, WACC ensures that growth happens in a way that creates value rather than destroys it. However, its usefulness depends on careful calculation, informed judgment, and understanding the assumptions behind it. When applied thoughtfully, WACC goes beyond being just a number. It acts as a strategic guide, helping businesses make smart investment decisions and focus on long-term value creation.